Dear students, knowledge seekers, and learners, welcome to Lecture 1 of Week 2 titled Structure of Indian Financial System. In today's lecture, we are going to start discussing specifically the foundation of the Indian financial system. In today's lecture, we will be talking about, first of all, overview of Indian financial system. Let us go through the contents of today's discussion. First, we will focus on overview of Indian financial system, followed by the need for a structured financial system. After that, we will talk about the broad structure of Indian financial system, followed by trying to understand the difference between organized and unorganized sector. Subsequently, we will delve deep into understanding the formal financial system components, followed by the role of regulatory authorities. After that, we'll try to work on to understand the institutional classification in the Indian financial system, and finally, we will touch upon the structural characteristics of India in terms of Indian financial system. Let us begin the journey. At the outset, it is important for us to develop an overview of Indian financial system. We all know that Indian financial system is the system which is represented by the geographical and political boundaries of India. It is also very important to understand that Indian financial system will always be characterized by what kind of country we are. Right now, we are a developing country, so the features of developing country will always be shared in the Indian financial system. Thus, in simple words, we can say that Indian financial system refers to institutional framework that facilitates financial transactions in India. What do we mean by institutional framework? Let us try to understand this. Say, for example, this is the whole scope of financial system. This is Indian financial system. Now, this financial system has some boundaries, has some foundations, and there are institutions that facilitate this system, they maintain this system. Now, institutional framework refers to how these institutions perform their duties, their responsibilities with respect to the financial system. The complementary behavior and mechanism of institutions and financial system is very important. Therefore, institutional framework is not something which can be undermined. It is something which can help to grow. It is something which will improve. It is something which can determine whether the financial system will become smooth or not. Indian financial system integrates several aspects and entities such as financial institutions, financial markets, financial instruments, and regulatory bodies. All these together, they form a financial system, but all these things also focuses on the institutional framework. Indian financial system has evolved significantly in the post-liberalization that is after 1991. The reason being, after 1991, when India became liberalized, open economy, then the challenges increased for the financial system as well as the opportunities for the financial system to learn and grow also increased. This provided a good benchmark for the financial system to gradually evolve, which is still continuing. Indian financial system is characterized by diversity of consumers, diversity of financial institutions, diversity of financial products and services, etc. It is also characterized by regulation. In Indian financial system, the regulations are quite strict, control is proper in order to safeguard the interest of the public, of the people, of the unbanked people, because still there is a large population in India that lacks financial literacy. It is also characterized by gradual modernization. So we have modernized in terms of how financial system works. A decade back, in order to take a loan, you would have to run from pillar to post, and it would almost take more than 30 days to sanction a loan. Today, with the use of digital technologies, e-stamp papers, e-signatures, etc., a loan dispersal can happen within 2 to 3 days. All these modernization have been possible because Indian financial system is still evolving. Let us now try to appreciate the need for a structured financial system. There are large and diverse economic parameters. India is considered to be a large economy and diverse economy, and such a large and diverse economy requires organized financial coordination. Now, this organized financial coordination refers to when we have some formal set of rules and regulations. Those rules and regulations that comes in order to discuss the issues, those rules and regulations that provide clear guidelines of how the different financial entities are going to interact, are going to trade, etc. A structured financial system ensures efficient flow of funds. That is, funds can flow to those areas or sectors that are giving better returns in comparison to other sectors. Giving better returns also reflects on the point that these sectors are performing much better than others. Similarly, a structured financial system ensures stability in financial operations. Stability in financial operations refers to primarily that the operational cost should not fluctuate. Similarly, it also means that financial operations do not create panic in the consumers, in the investors, etc. A structured financial system also ensures policy implementation. Policy implementation is very important. We know that public policy or policy in financial sector is important because people respond to policies and the incentives that are being placed in the policies. Thus, policy implementation is very important in terms of financial system. A structured financial system thus prevents fragmentation and inefficiencies in the economy, and if we are able to curtail these two things, that is fragmentation of the funds and inefficiencies in the investment, then a lot of panic and crisis can be mitigated in the economy. Therefore, we need to understand that structure in a financial system provides order, that is rule of law, control, that is monitoring is possible, and efficiency, that is flow of funds in those areas or towards those sectors where return is good. Let us now try to understand and decipher the broad structure of Indian financial system. The Indian financial system is divided into two types. First, organized financial system, and another the unorganized financial system. The organized financial system is one where everything is formal in nature. everything is on record. The data is collected for each and every entity. On the other hand, the unorganized financial sector is one where we have no such rules, no such formal structure, etc. In Indian financial system, both organized financial system and unorganized financial system coexist. But the organized sector always dominates the policy focus. Let us now try to understand the organized financial system. The organized financial system is regulated and supervised by authorities. These authorities are the heads of the institutions. Examples of organized financial institution means where it is being regulated. For example, SEBI, Securities Exchange Board of India, IRDA, Insurance Regulatory Development Authority of India, etc. Organized financial system includes banks such as RBI, SBI, etc. Financial institutions, such as institutions like the NPCL, financial markets, Nifty, Sensex. We have also the organized financial system operates under formal rules and regulations which are being ratified, and also an organized financial system provides transparency and security. What do you mean by transparency? Transparency means that whatever parties and stakeholders are involved in a financial transactions, those stakeholders get all the information related to that financial product. Let us now try to understand the unorganized financial system. Unorganized financial system is not formally regulated. Because it is not regulated, but still it has a huge consumer base, it is also very important and integral part of Indian financial system. However, over the years, the unorganized sector is shrinking, and the government initiative is that the unorganized sector people, the unbanked people, should also try to be part of the organized sector. The unorganized financial system includes money lenders, those who give money locally based on some collateral, that is household collateral, or based on trust as well. But they have a huge and a strong network and means of recollecting money from the debtors. Another includes indigenous bankers, bankers who are self-made and who work and function in a particular area, informal financial agents that always acts as intermediary between some financial company and consumers. It is flexible. The feature of unorganized financial system is it is flexible. It tries to give money to everybody, to finance everybody, and for that they are ready to become flexible in their rate of interest, in the agreement, etc. But the problem is that they generally charges very high interest rate. Now high interest rate is a kind of burden of people, and that is the problem which they face. Unorganized financial system is still relevant in rural and informal sectors like the mandis, like people who are roadside stallers, the hawkers, etc. All these people, they heavily rely on unorganized financial system. Let us now try to understand and highlight the structure of organized financial system. The organized financial system consists of financial institutions, financial markets, financial instruments, that is products, financial services, underwriting, etc., and regulatory authorities. These together form the core or structure of the organized financial system. If any of the sector, any of the entity among these five becomes weak, then we will say that the organized financial system of a country is becoming weaker. Let us now try to understand the classification. One is financial institutions. These are banking institutions plus non-banking financial institutions, popularly known as NBFCs, non-banking financial corporations. Development financial institutions, they are the major classification in organized sector. They differ, all these three, they differ in their functions and objectives. Banking institutions, we have central bank, that is in India, it is Reserve Bank of India. Commercial banks, all the banks that are there for earning profit or whose objective is profit maximization. Regional rural banks, in short known as RRBs. We will be discussing them in detail in future lectures. Cooperative bank, they are there with some objective of helping people, particularly in different sectors like agriculture being a priority sector. And also these banking institutions, they form the backbone of financial system because largely the day-to-day finances and their issues are being dealt by banks. Thus, these banking institutions handle deposits, also take care of credits, and also make necessary payments. Dear students, knowledge seekers, and learners, let us discuss another classification and entity, that is NBFCs, non-banking financial companies. Non-banking financial companies are a specific form of companies which are financial institutions, but they are unique in the sense that they are being regulated both by the Banking Regulation Act as well as by the Companies Act. These NBFCs provide financial services without full banking functions, and they can be divided into three types. They can be an asset financing company, they can be working capital financing company, and they can also be a company which is facilitating real estate. These non-banking financial companies may also be divided into type, whether they can accept public deposits or not. Generally, non-banking financial companies cannot accept public deposit, but still few can be granted permission. So they are NBFCs that can accept public deposits and that cannot accept the public deposit. This is also a classification. So these non-banking financial companies, they either are labeled as NBFCs or they are the insurance companies, mutual fund companies. These non-banking financial companies, they complement the banking system and they are important for credit expansion, particularly in backward regions, in the marginalized sections of the society. Means it is very important for the unbanked people. One of the important financial product or instrument that is being used for the marginalized sections of the society in Indian financial system has been microfinance. Now you will be surprised to know that most of the microfinance company, almost all the microfinance companies, they are under NBFCs, non-banking financial company. So they are such an important element for the Indian financial system. Let us now talk about another type of entities, development financial institutions. Development financial institutions provide long-term finance. They are there for the development of the country and their funding will only come where there is some kind of development. So the focus areas of DFIs include industry, agriculture and infrastructure, with infrastructure being the most priority sector in the sense that it is easy to decide how much funding is required and the return is also very high. Now, development financial institutions, what they do is they support economic development projects in the Indian economy. Financial markets in India, another important classification. Financial markets in India are platforms for financial transactions. There are two main types of financial markets in India. One is money market, which is a short-term fund market where money is being traded, finance is traded based on the day-to-day profits. And then we have the capital market, which is for market for investing in long-term funds and returns are expected in a longer period. The financial markets in India, when they become organized and they have been divided into type of functioning, this makes them unable to efficiently allocate the capital. What are the different financial instruments in India? Financial instruments are the tools that are used for investments. The examples of financial instruments include treasury bills, bonds, that is debentures, and shares. These are just an example. There can be more blended type of securities, and financial instruments in India reflect borrowing and lending relationship. Let us now talk about financial services in India. Financial services in India support financial transactions and it includes banking services. It also includes insurance services. It includes investment services and it enhances the efficiency and accessibility. It is very important to appreciate that all these services they facilitate trade and development in the economy. For example, insurance services are very important for cross-border trade. Investment services are important for expansion and diversification of the existing industrial sector. Banking services are important for facilitating the economic transaction. So overall, the financial services in India are very important, particularly at a time when service sector in India is booming. Let us now talk about the regulatory structure. There are certain major regulations that will fall under the regulatory structure and which are very important to be dealt with. The Reserve Bank of India, through different rules and regulations, takes control of all the commercial banks and other financial entities. Securities and Exchange Board of India, which is responsible for the share market and to control malpractices in the share market. Insurance Regulatory and Development Authority of India, which regulates all the SOPs, the rules and regulations for insurance companies. Now, what happens because of a presence of regulatory structure? Regulatory structure ensures stability, transparency, and investor protection. Dear students, knowledge seekers, and learners, let us now focus on the structural characteristics of Indian financial system. Indian financial system is a mixed structure, that is, it has both organized and unorganized sectors. Indian financial system also has a strong regulatory framework based on the different financial institutions and authorities that are working to prevent any misuse of the financial system. Indian financial system currently is also characterized by increased digitalization, one of the examples being UPI usage, that is Unified Payment Interface usage in terms of buying and selling in the economy. Indian financial system is also characterized by expanding financial inclusion, that is bringing the unbanked people into its organized fora. Thus, it would be justified to say that Indian financial system has worked well and now it is transitioning towards a modern financial system. Still, India being a developing country, there are several challenges for the Indian financial system. The first challenge is regional imbalances between different geographical regions within India in financial access. The second problem and the challenge is dependence on informal sector in the rural areas. The third important challenge is the limited financial literacy. So people in rural areas, in some urban areas, they do not understand the structure of a finance, the financial risk. They do not understand financial products, etc. And another important challenge is uneven credit distribution. So all these key structural challenges are very important to be looked upon for the good future of the Indian financial system. But remember that this structure of Indian financial system is evolving and it is not fully uniform, neither it is static because it works according to time and situation. Dear students, knowledge seekers and learners, whatever we have learned and discussed in today's lecture, let us now summarize. So, we have discussed and highlighted that Indian financial system has a dual structure. That is, it has both formal and informal structure. We have also appreciated the point that an organized sector plays dominant role. In addition to this, it is justified to say at the end of the lecture that Indian financial system includes institutions, financial markets, financial instruments and regulators. In the end, we will say that Indian financial system continues to evolve with reforms and technology. Dear students, thank you very much for being with me in this.